In this video, we're going to compare two studies to answer the question, is it better to trade wider credit spreads with less number of contracts or narrow credit spreads with a greater number of contracts? Now we know that if we trade more spreads, we will incur more commissions. So is it better to widen that spread to reduce the commissions? And what will that do to the profitability? All right, so I have the first backtest up, and let's talk through the settings so we understand what we're trading. And I'm inside of Option Omega, and I am selling a call credit spread with 7 days expiration every Wednesday at noon. So a couple of the parameters is we're selling slightly out of the money. The short call is going to be a delta 40, and we're going to buy a call that's 10 points higher. So this is a 10 wide spread on SPX. We're doing 7 days to expiration every Wednesday at noon. This is Eastern time. And this is very, very important, and actually helps answer this question. We're going to be allocating 10% of the portfolio. Now, I've just simply set up a $10,000 allocation, and that means when it takes the trades, it's going to choose the number of contracts so that it doesn't risk more than 10%. So in this case, 10% of 10,000 would be about $1,000. When we look at the results, it actually did pretty well. We had 12 trades, 10 winners, 83% win rate. By the way, I'm not recommending this strategy. It's just for illustration purposes, and this is going back just 90 days from the time I'm making this video. We're really kind of focused on the width. But I wanted to talk through the trade log, and I think this is going to help answer that question. So when you sell a 10 wide spread, in this first example, there was a credit of $4.45. So what that means is that the max loss on this trade would be $5.65 because you take the width of the spread and you subtract the credit. That is your max loss in case things go horribly wrong. And because we're only risking $1,000, we can only trade one spread. So this is going to basically trade one spread at a time. Eventually it would get to maybe two spreads as the account grew or the allocation grew, but in this short 90-day example, it basically traded one spread per trade. Again, 12 trades, 10 winners. Now I did have a profit target set up so that it would take profits at 50% of that max gain, which is the credit. And I also added just some basic fees, opening fees of 65 cents, closing fees of 65 cents, just so we can see if this affected the strategy if we go a little bit more narrow. When you trade one contract per trade, we're only going to be incurring one fee for the entry and the exit. So let's do the same test, but let's narrow the spread so that instead of 10 wide, it's actually 5 wide. So I'm going to go into Option Omega. And by the way, if you're interested in using Option Omega, I have a 50% discount code in the description of this video. You can use the code SMOT or SMOT for stock market options trading on their website to receive a 50% discount on their software. So now that I'm in the editor here, instead of 10 wide, I'm going to go 5 wide. Everything else is the same. We're going to sell the same short strike, 7 days expiration, same time of day, same day of week, and we're going to do our 50% max profit target. So let's go ahead and hit run, and this thing's going to run pretty fast. Now look at how much better this strategy did. It actually ended up with 11 winners. It actually increased the win rate, which this sort of blew my mind when I first saw this. But what's even more impressive is the amount of money that it made. It made $2,650 more than the 10 wide spread version with the same setup, same everything, except the only thing we changed was the width of the spread. So I thought that this was amazing. When you think about taking a $10,000 account, trading one trade per week and turning it into a almost $1,400 account over the course of a few months, I think that's pretty amazing. Again, don't follow this strategy. It's just more for illustration. But the question is, well, why is this? Why did this make so much more money? And the reason is because it comes down to the percent that you're allocating and the risk, right? So if we're allocating 10% or we're risking 10% of the portfolio, let's go back to the trade log here. Well, notice that with a 5 wide spread, we received a credit of $2.30. So the max loss is going to be $2.70. That means I can trade 3 contracts for this particular strategy and still be within my $1,000 risk parameter. But the 10 wide spread, remember, we can only trade one spread because the max loss was so big. So even though we are going to incur more commissions because we're opening 3 spreads, the amount of profit we were able to book is actually a lot greater. I still have to figure out why there was actually one more winner. That's probably some intraday, something happened where intraday one of these trades got hit its profit target and the other one didn't. That may not be consistent, so I don't want to say that your win rate's going to be better with a narrower spread, but I will say when you do a proper allocation, the capital efficiency is going to be much greater. And we kind of knew this, right? We kind of knew that narrow spreads had a better capital efficiency than wider spreads because you don't need as much capital to trade them. And this study is simply sort of illustrating that. So if we scroll down a little bit, we can see that we started with 3 spreads, and then as the account grew, it started taking 4 spreads because it's still staying with the 10%. So eventually you get to where you can risk 1,100 or 1,200. And then we finally got the loser, which always happens when you scale up, right? And listen, if this is your first time coming by the channel, my name is Eric. Consider subscribing, hitting that like button. I'd love to know what you think in the comments, and we'll see you in the next video.